Welcome back to What Your Money Would Say. I'm Andrew McNair from Swan Capital, and we have a very special edition of our show today. We have a special guest, and it's truly my pleasure to be here with Professor Robert Shiller. He's a Nobel Laureate. He's the professor of economics at Yale University, and you probably know him as a New York Times best-selling author. He is the author of Irrational Exuberance, and his newest book, Narrative Economics, just came out this year. Professor, it's great to be with you today.
It's a pleasure for me too.
Here's a startling statistic that I want to begin with. 10,000 baby boomers are retiring every day. Professor, how ready for retirement is this generation?
Well, I think we're more ready for retirement on average than 100 years ago, but it still isn't good enough. A great many people are retiring with virtually no savings, or the saving would be just in their house, so they're called house poor. You know, I think people today are not so eager to move in with their children and let their children support them, which is what used to be very common. So I think they're ready for some disappointment. They'll run out of money before they die.
And I know that's one of the biggest concerns of people entering retirement is running out of money before they actually pass away. And I want to talk about just the state of the economy right now and what we see out there. Interest rates, we know, they're not what they used to be. They're going lower, it seems, every day. We have bond yields at historic lows, and stocks might not be as reliable as they once were as they continue to appreciate. So how should people nearing retirement begin to change their mindset?
Well, I think there's a lot of differences of opinion about that because we don't know the future. The usual statement is that retirees have to plan for a less risky investment because they can't endure the downturns in the market. Well, they'll be suffering more because they don't have labor income. Well, some of them do. Retirement is often partial, but those who are totally retiring will not have labor income. And what do they do if there's a collapse in the markets? So what can we do anticipating that risk? I think the best thing to say is you want to diversify your portfolio. And avoid reliance on any one asset class, and you'll probably do all right. And you'll make it through the hard times.
As I say, Professor, don't put all your eggs in one basket. Now, you mentioned that those people in retirement, they can't endure those downturns like they used to in the market. So if we're planning for retirement and we do see an up market, how do we take advantage of that, but also not risk too much either?
Yeah, well, that's, again, a question that you'll have many different opinions on. I would say don't overinvest. I've already said that. Diversify.
Professor, we know there's an election coming up in 2020, and it can certainly influence the market. But we all know it's not just about elections, right? There are natural disasters. We have international conflicts, trade disputes. The list could go on. Why is it that the market can so easily be affected by all these outside factors?
Okay, that's controversial. So many things are in economics. But I think that the main reason is human psychology. If you look at the major market moves, they're not justified by what happened. You know, the efficient markets view, which has been very popular, I think it's losing its popularity, says it's all due to fundamentals. There's always some fundamental reason. So the stock market crash of 1929, they would say, happened because people saw the depression coming. But I think that isn't right. They didn't see the depression coming until after the stock market crashed, and then they got scared. So, it's a little bit hard to generalize from history. History is so complicated. But I think we've learned that there are risks, that we shouldn't be too intimidated by them. You know, even during the Great Depression, most stocks survived. Even the Dow Jones 30 industrials, they all survived. They didn't go bankrupt. There were famous bankruptcies. And that was the worst depression ever. So I think people have to avoid being too fearful, but at the same time be practical and to diversify.
It goes back to the human psychology you mentioned, and there's a lot of noise out there. Professor, people are always seem to be speculating when the next crash or recession will begin. In your research, I want to ask you, have you seen anything that shows that consumers are affected by what's being said in the news and the media, and then in turn affects what the market does?
Yeah, this is the subject of my new book, Narrative Economics. Narratives are stories with a moral, stories that change the way you think about things. Economic narratives are things that make you not want to spend money or invest as you had. And those things do. Now, it's hard to prove in a court of law that it feeds that, but I think I have a pretty good case that psychology feeds back, and the narratives feed back into the markets. And we have to watch narratives as they develop. One very important narrative is about confidence, that markets are affected by confidence. It goes back to Franklin Delano Roosevelt's famous speech in which he said, the only thing we have to fear is fear itself. So people are looking at each other trying to decide, are we fearful now? And if they're fearful, we'll get fearful. That's unfortunately human nature. Right now, we're doing all right. Let's hope it continues.
Indeed, there's a lot of noise out there. And we talked about that earlier. Should the average investor be paying attention to that, or should our focus really be on making sure that our goals, no matter what they are, be aligned with our investments?
Yeah, so you can ask about the average person. Probably they shouldn't get too involved in worrying about the markets. They should just diversify. They should also consider getting a financial advisor. You don't have to actually do a regular monthly meeting with your advisor, but having a meeting or two to just go over what you're doing, I think makes good sense.
So what about the people who already retired? Are there any trends that you're seeing or anything you're anticipating really that might have an impact on those retirees?
Well, one thing that we have is very low interest rates. And a lot of retirees have been investing in fixed incomes because they're risk averse. And it's true, they should be somewhat risk averse. After you retire, you're more vulnerable. But some of the retirees have a rule of thumb that they will only consume the interest from their bond and money market portfolio. That's going to be a disappointing strategy now when interest rates are so low. So maybe they have to rethink that. Maybe a financial advisor could help them rethink that.
That's right. Maybe get some guidance along the way. So interest rates are low. We know that housing isn't the greatest investment. We were told it's supposed to be, but it's not always liquid either. And then we've got the stock market with all of its volatility. Professor, is there any good news that you can think of that we can leave our listeners with today?
Well, this isn't exactly news, but I'll call it good news. The good news is that the U.S. economy continues to grow. If not at breakneck pace, it's going up. It'll probably go up at 2% a year in coming years. And that means that America is getting wealthier and wealthier. And ultimately, that's going to help. There'll be more support. The downside is that it's not a downside. Medical progress is extending life expectancies. You might live to be 100 years old. You better plan for that. I think that there will be some social welfare that will help protect you. You have to carry kind of a mind about it that it's not going to be amazing and it's not going to be horrible. You'll get through it. But the good news is, yes, our economy is growing, and we are not in a period of war or famine or anything like that.
Professor Shiller, we know that traditional pensions are going by the wayside. I mean, we're becoming a pensionless society. Not many people have those anymore, but most people like the idea of having a guaranteed income stream. I mean, it's very attractive, especially for people in retirement. Is there any way that we can try to achieve that in retirement? And I mean a 21st century retirement.
Well, there are products that help you protect, as you say, give you an income stream. I'm thinking of fixed index annuities. We also have target date funds that would gradually on their own shift your investments to less risky portfolio, rather than have you try to manage these complicated markets yourself. As you approach your retirement date, you might forget to downplay the stock market relative to the bond market, and then you might get caught in a crash if you don't have some professional investors managing the dynamics of your portfolio. So again, I think one should have advisors and one should invest in products for people anticipating their retirement.
Professor Shiller, as we look at those products, those smart financial tools that are available to us these days, is this something that pre-retirees can go out and just find on their own?
Yes. Well, you can search the web and find things. That's what most people do. They also ask their friends for recommendations of who to talk to. But I still think that ask your friends for who would help advise you in your portfolio, who has been helpful and who seems sincere and genuinely disinterested. That's the lesson I would draw.
You also mentioned longevity, too. It's actually quite a risk to retirees now. I mean, these days we're living much longer than ever before. You mentioned to plan to at least age 100, which sounds amazing. And it's true. I mean, I have a client that's 103 today. I think it's amazing to be alive, to see people living this long like never before. But no one wants to run out of income. These products that you mentioned, can that help with ensuring that you'll have the income you need throughout your life?
Well, one thing is an annuity, a life annuity, does exactly that. It can have a simpler form. It can have a very simple form that just guarantees an income. And if you live to be 200, it's supposed to do that. No one lives to 200. I suppose there are always some residual risks. But I think there has been a relative lack of interest in annuities as a protection for running out of wealth before you die. That is a problem that every single human being shares. So we should see 100% participation in these markets, and we still certainly don't.
We've seen annuity products evolve over the years. They're not like the old annuities of maybe 15 years ago. They're set up and created a lot differently. Why do you think there has been the resistance towards annuities, and how do you think that's changing?
Well, I think there's a trust problem. That people feel they don't want to tie up their money in one asset. Looks a little strange and unfamiliar. Are the neighbors doing it? Well, maybe the neighbors are. There are a lot of people buying annuities, but percentage-wise, it's not dominant. People still manage intuitively with little guidance from experts. So it's a conservativeness that people have in their investments. Even investments that look very well designed for them, they miss them.
Professor, it sounds like they could play an important role in a comprehensive retirement plan. They definitely are not the only investment that people should have, but in a comprehensive retirement plan, it sounds like it makes sense. As you said, you shouldn't put all your eggs in one basket. And we talked about that earlier. This is really a part of a well-diversified retirement plan. Am I right?
Well, Mark Twain is alleged to have said, put all your eggs in one basket and watch that basket. Maybe he was quoting someone else, but it's a great phrase. The problem is you won't watch that basket. It's human nature. Watching investments is a job for professionals.
Indeed it is, and it can be a full-time job managing your investments, and that's no way to enjoy your retirement. It goes back to your advice to get that trusted input and guidance along the way on our journey to and through retirement. Professor Shiller, it's been a pleasure speaking with you today. Look for his book, Narrative Economics. You can find that book wherever books are sold. Professor, thank you so much for your time today.
My pleasure, too.
The interview with Robert Shiller was not paid for. Robert Shiller is not affiliated with, nor is he endorsing the radio show, the host, or the firm. All investments are subject to risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss in periods of declining values. Any references to protection benefits, lifetime income, generally refer to fixed insurance products, never securities or investment products. Insurance and annuity product guarantees are backed by the financial strength and claims-paying ability of the issuing insurance company. Annuities guarantee an income stream which may or may not be sufficient to cover the expenses of the annuitant.
Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC and or Swan Capital. AE Wealth Management and Swan Capital are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Swan Capital is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the United States government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Swan Capital.